Hello all. Good morning, good afternoon, good evening, and welcome to Nish. I hope you can hear us well. Right. We'll start off by introducing ourselves. My name is Nashida. My nickname is Nish, and I'm the founder and managing director of Nish. I founded Nish about 6 years ago. Nish is a professional services firm. We are into providing outsourcing, consulting, and assurance services, and our expertise is in accounting and financial reporting, and particularly technical accounting, IFRS areas. Our expertise is also in business processes as well as various taxes and compliances. And that's Nish. To speak a little bit about myself, I have been in Dubai for more than for 30 plus years. I came here in 1991, so 3 decades and counting. And of that 3 decades, for 18 years, I have been in the profession, 2/3 of it with a Big Four. And one of the things is of my life in Dubai is of the three decades that I have been here, for 2.5 decades, tax was something that happened, something mysterious, something complex that happened to other people in other parts of the world, but not here. All that changed about 5 years ago when excise tax was introduced, and then subsequently VAT was introduced. VAT in particular made a big difference. Excise tax was essentially, impacted a few people, a few businesses, but VAT had it was a more broad-based tax, and it had implications, impact on almost every single business in the country. And now it's about 5 years since VAT was introduced. In fact, in about a week, we will be completing 5 years since the implementation of VAT. And now what we have is a new type of tax called corporate tax, which is the reason why we are running this session today. So the focus today is going to be more practical. Now, we do understand that, just like me, a lot of other people here are not necessarily familiar with corporate tax. And therefore, the intention of the session is to essentially introduce the concept and then to give you a more practical kind of flavor. So we will try and use more less technical jargons as much as possible, but we can't avoid it completely. So where we are using technical jargons, we will try and explain it in layman's language as much as possible. Before we go further, I will introduce, I'll ask my colleague here, Nisha. She's the tax manager with us. Nisha, can you please introduce yourself?
Sure, Nish.
Yeah.
Hello all, I'm Nisha. I'm tax manager at Nish. I have been working with Nish for past 5 years. Prior to that, I was working with Deloitte USI in the global tax division. I have also experience in GCC tax and corporate tax, especially in KSA. Unlike Nish, my experience with tax in UAE is completely different. VAT was implemented in 2018, and that was the time when I started working in UAE as well. So for me, it was VAT and then other compliance requirements like ESR, UBO, all coming in, I believe, as a build-up, as an introduction for laying a base for a CT. So Nish, what is CT?
All right. Okay. So let's start by looking into what exactly is CT. And when you think about CT, we all know that it's a kind of tax. Yeah. And the first question in anyone's mind is, does it impact me? How does it impact me? Am I, expected to pay? Is there any way I can get out of it? And if there is no way I can get out of it, then, what am I really expected to do? What is the financial implication on me, et cetera, et cetera? So these are the kind of questions that we're trying to cover in today's session. Yeah. So when we tackle something new, I think it always makes sense if we start comparing it with something which is already in there.
Yeah.
So VAT is a tax that has been, like I said, around for 5 years, and most businesses here are kind of familiar with how VAT functions. So let's do a compare and contrast between a very, very high level compare and contrast between VAT and corporate tax. Yeah. So VAT is what we would call an indirect tax. Now, mind you, both VAT and corporate tax are ways of raising revenues for the government. The objective is the same, but the way they both do it are entirely different. Yep. So VAT is what we would call an indirect tax. Now, what does that mean? If I go to a supermarket and I'm buying various things, the invoice that I get will have a 5% tax on every single item that I'm purchasing from the supermarket. Okay? Now I'm paying that amount to supermarket, and what the supermarket does is they take all of this VAT and then they pay it over to the tax authority. So that is what is called an indirect tax, because even though I'm the consumer, I'm the person who is bearing the tax, I am not the one who is paying it directly to the authority. It's a supermarket who's collecting from me and paying it on my behalf. So this is what we would, so supermarket is effectively acting as a collection agent on my behalf. Yeah, the supermarket really doesn't, the supermarket's P&L or supermarket's profits are really not impacted by VAT unless there are certain non-deductible expenses. CT is entirely different. It is what we call a direct tax. So the business that is bearing the tax is also paying it to the tax authority. Yeah. So it's not just a cash flow impact, it actually impacts the profit that we can take home. Yeah. One other major difference between VAT and corporate tax is that when it comes to VAT, VAT is what we would call a transactional tax. It impacts every single transaction that you undertake. So every sale, every purchase, you have to ensure that it follows the VAT law requirements. So it's quite procedural that way. So you have to ensure there is a tax invoice, etc., etc. CT, on the other hand, is computed on your total profit for the entire year. So there are less procedural aspects when it comes to CT, but arguably there are a lot more judgments when it comes to CT. Yeah. So what we will do is, maybe we will start with a refresher of, because we have been seeing a lot of press reporting around CT in the last few days, weeks, months. So maybe we'll do a quick refresher of what we are seeing, because we're seeing bits and pieces of information here and there. So Nisha, could you please, take through, and could you also tell us where we are right now in relation to the implementation?
Right.
Yeah.
So as Nish said, we have information in bits and pieces. Maybe you have not read the law, maybe you have not read the public consultation, maybe you have not read anything, but you might have seen newspaper cuttings, you might have in your discussions come up with certain concepts here and there. So what do we already know? June 2023. So anybody who has heard corporate tax knows June 2023. That's when CT is going to implement. So if you are a business, your financial year that starts on or after June 2023 is going to be under CT regulations. We know the tax rates. We have heard 0%, we have 9%. So 0% up to a certain amount and 9% when it exceeds the certain amount. And that certain amount is expected to be 375,000. I say expected because it's not clear. Maybe it's clear. When it comes to free zones, what do we know? Are the rates same, different? I would say yes and no, because it's 0% for qualifying income and 9% which is not qualifying income. Now, qualifying, non-qualifying, Nish will cover in our further session. The other important thing is about the Pillar 2 and the alternate tax rate for multinationals. There is no reference to it in the law. The other sections that we might touch upon will revolve around these information that we know. Now, if I step back and see the journey of CT, as I would call it, Jan 2022, that's when the ministry announced that there will be taxes, there will be corporate tax on taxable income starting June 2023. Coming forward to April 2022, ministry released the public consultation Now, I would call it as a welcome move by the ministry, because through public consultation, what they eventually did was get comments from businesses and stakeholders on their comments regarding CT. It was through a form, and the form was available till May 2022. Now, fast forward to December 2022. The law is released, and along with the law, we have a set of FAQs by the ministry. There are around 158 questions that will answer various queries that businesses and stakeholders have regarding CT. Now, one thing to note here is, as I said, we have press releases, we have public consultation, we have FAQs, and now the law. And there might be conflicting information available in all of these. So what you should remember is that the law prevails.
Yeah.
So what does the law say, Nish? Who is subject to tax?
Yeah, no, definitely. And maybe just one point to add to that is that the law in itself is incomplete.
Right.
Because when you read the law, it refers to, in a number of places, it refers to further decisions, further cabinet decisions that will come out. And when I say in a number of places, at least 40 to 50 places, it refers to further cabinet decision. All right, so let's now get into a little bit more detail. Yeah, the first question, obviously, in everyone's mind will be, am I subject to tax? So let's get into that in a little bit more details. So before we get into it, we really need to understand certain definitions and distinctions, how much ever you would want to avoid them. Unfortunately, if you don't understand it, then you won't understand the rest of it. So the very first distinction is between a juridical person and a natural person. Now, a natural person is a human being, an individual like me, Nisha, and yourself. Yeah, a juridical person is essentially a legal entity. It's like an LLC or a public limited company, etc., etc. Now, you may have sole establishments and civil companies. The law doesn't necessarily say where they fit in, but if you look at the FAQs, they do say that civil companies and sole establishments are considered to fit within the natural person definition. Yeah. The next important definition that I want to cover is corporate tax. So this is how the law defines corporate tax. It says it's the tax imposed on juridical persons and business income. Sorry, there's an I missing there. But it was not intentional. Anyway, so if we were to really go into the details of this particular definition, it's a very simple definition, but if we were to just reflect on it a little bit, it says juridical persons and business income. So the first one is a type of person, the second one is a type of income. And why is that? If you are a juridical person, then you should assume that all your income is subject to tax, unless there are specific exemptions in the law. And we will talk about exemptions in the law a bit later. On the other hand, if you are a natural person, you should assume that none of your incomes are subject to tax unless it comes within the definition of business income. All right, so let's look at what is the definition of business. So the law defines business, and this is just a portion of that definition. It goes on to say a little bit more, but this portion from our perspective is the most important. So what it says is a business is an activity conducted regularly on an ongoing and independent basis by any person and in any location. So if we were to apply this to some of the things, so for example, Nisha she works as a tax manager with Nish. She's obviously doing a lot of business related activity, but she's not doing it on an independent basis. She's actually doing it on behalf of Nish, and therefore her income, her salary that she gets from here doesn't fit within this definition. If I sell my 10-year-old car, and my car is actually 10 years old, if I sell my 10-year-old car, then the income that I get from that also will not fit within this definition because it's not a regular ongoing activity. I'm not a dealer of secondhand cars. On the other hand, if I have a side hustle where I'm baking cakes at home and selling, that could potentially fit within this definition.
Right.
Yeah, and I know a lot of people, I don't do this, but I know a lot of people who do this. The second aspect of this definition that you really should focus on is any location. So that means any location means not just UAE, but also other countries. Yeah. So let's now proceed forward and we'll look at a few more definitions. So another important distinction is resident person and non-resident person. Now, if you've been following the press, about a couple of months ago, there was a law published, and it's effective from March, and this is about tax residency. So essentially, the law helps us define which juridical person and which natural person will be considered as a resident. What are the criteria, conditions under which they will be considered as a resident in the country? When it comes to juridical persons, the decision is quite simple. If it is a company registered in the UAE, it's a resident in the UAE, and that includes free zones, okay? But if it is a natural person, then the decision is, based on different criteria. It tends to look at your visas. It tends to look at the number of days that you're staying in the country and a few other considerations. So we're not going to go into the details of those, but it is important that from a tax perspective, you understand that there is a difference in treatment between a resident person and non-resident person. In the rest of the session, we are not going to focus much on the non-resident person because it has its own complexities, but just a couple of points. Broadly, globally, when it comes to tax, there is something called a residence rule and a source rule. Now, what that means is if you are a resident in the UAE, then you are subject to tax on all your taxable income, irrespective of whether it is it's from the UAE or from other parts of the world. So if you're exporting services or you have a branch elsewhere or whatever, all of this will come under the residence rule. And if you are a non-resident, then you are subject to tax only on those income which are sourced from the UAE. Yeah. So that's the difference. So that's why it's important to define whether you're a resident or a non-resident. And another point that we want to make is, if you look at the source rule, then we're saying that any non-resident is subject to tax on their state-sourced income. Now, practically, the way the country is implemented is using two modus operandi. Yeah, the first one is if you have a permanent establishment in the country. Now, permanent establishment could be a branch or an office or whatever. There's a whole world of explanation on what permanent establishment is about, and we won't go into detail. Sometimes, even when you have a local agent, then that could be construed as having a permanent establishment. But the point is, if a foreign company has a permanent establishment in the UAE, then they will be subject to tax on the activities of the permanent establishment. On the other hand, if there is no permanent establishment in the UAE, so they may be exporting to UAE or they may be, selling some services in the UAE or whatever, in those cases, they are subject to withholding tax on their services. Now, withholding tax rate is under the UAE law, it is set at 0% currently, which means effectively those activities are not subject to any tax. The FAQs also state that they are not subject to any kind of filings or returns. Right. Now, moving on. Yeah. So we mentioned a bit earlier that if you are a juridical person, then you are subject to tax on every single activity, on every income that you earn in the country and outside the country, every income that you earn, basically, unless it is covered by some exemptions in the law. So we're going to look at the nature of exemptions. Yeah. Now, under the law, there are two types of exemptions. One is certain persons are exempt. The other one is certain incomes are exempt. So income exemption is something that we will cover a bit later when we talk about what income is subject to tax. Right now, let's focus on the people, the persons who are exempt. Yeah. Now, again, there are three subheadings under this. Now, mind you, this is not the way the law is set out. All of these items are scattered in various parts of the law, but The law has a list of exempt person in it. We will cover that list in the next slide. The law also speaks about free zones. So again, we will cover in the next slide. I know that a lot of people who are listening in today have businesses in the free zones, and therefore, fingers crossed on what the law says on free zones. So we will cover that in a little bit of detail in the next, in another slide after this. Thirdly, there is something called small business relief. So what does that mean? If you are really a small business, and you're probably not exempt in any of this, but if you're a small business, then you may not be subject to tax. But a small business, the law says, is businesses which have revenue below a certain threshold and which also meets certain conditions. However, what is that threshold and what are those conditions are not set out in the law. As we said earlier, the law refers to a number of future cabinet decisions. So in this case also, there is a reference to future cabinet decisions. So we'll have to wait until that cabinet decision to come out before you can determine whether you will be eligible for the small business relief. Now, one point for you to note is that even if you're eligible for small business relief, you may still be required to file returns. Yeah, it may be simplified returns. You may still be required to file something. So you're not off the hook completely. Yeah. So let's now look at the list of exempt persons. Yeah. And when you actually go through that list, we can, kind of understand the rationale for those exemptions. Yeah. So first is government and government controlled entities, because they're doing the government kind of things. And, that's not necessarily intended to be a profit making activity. So government and government controlled entities are exempt. Secondly, extractive and non-extractive natural resource businesses. Now, the reason why these are exempt is because there are already existing taxation in the 7 Emirates in the UAE on these kind of businesses. So to the extent the business is already taxed under the existing Emirate level taxation, these businesses are exempt from the corporate tax. Now, a qualifying public benefit entity is also exempt. Now, a public benefit entity is like a not-for-profit organization, charity, forums, clubs, chambers of commerce, etc. Now, evidently, they're exempt because their objective is not to make profit. And what is also exempt is qualifying investment funds and pension or social security funds. Now, we're not going to go into any further details on exemptions, but just 3 things for everybody to remember: that the definitions in the law of each of these type of businesses is very important when you are trying to evaluate whether you will be eligible for this exemption. Yeah. Secondly, it's not a blanket exemption. There are conditions and criteria and qualifications to be met in order to be eligible for this exemption. In general, if any of these businesses are doing anything which resembles a business, earning a profit from it, then they will not be subject to exemption. So it is important to go through the details in the law. Third, exemptions are not automatic. So even if you were to meet the conditions and qualifications and definitions, there is no automatic exemption. Either in some cases, you have to apply for the exemption and get approved, or in other cases, you have to be listed in a cabinet decision. So for example, the public benefit entities, there may be a cabinet decision listing the entities that will be qualifying for that exemption. Okay. Now moving on, free zone persons. Yeah. Now, So free zone persons, what the law says is qualifying free zone persons pay tax at 0% on qualifying income. Now you may want to just step back and think about it. There are 2 qualifications here: qualifying persons and qualifying income. This applies to every single free zone in the country. And this also applies to even branches of foreign entities which are registered in the free zones. Yeah. Now, first, what is a qualifying free zone person? The law says you have to maintain adequate substance in the UAE and meet certain other conditions. Yeah. So let's first talk about adequate substance in the UAE. About 2 or 3 years ago, UAE had introduced something called economic substance regulations. Under those regulations, certain entities which do certain activities, they call relevant activities. So businesses which are into relevant activities had to do certain reportings every year, certain filings and returns on an annual basis. Now, the objective of those filings is to ensure that these companies or these businesses are located in the UAE because they actually have proper commercial substance and not to obtain a tax advantage. So the reporting focuses on stuff like, do they do core income generating activities here? Do they have sufficient people here? Do they have sufficient assets and expenditure and resources here? And do they have sufficient decision making in the country? Now, we're not clear whether the adequate substance in the law would refer to that law in any way. But then when we talk about adequate substance, broadly, we should assume that this is the direction in which it's going. Yeah. Then there are other conditions. Now, some of those conditions are meeting certain provisions within the tax law itself, but then there are also other conditions that will come out in a future cabinet decision. So we don't know exactly what they are. There were some indications in the consultation document that Nisha touched upon earlier. However, I wouldn't want to go into details of that because we've seen that some of the clauses in the law do not necessarily go aligned to the public consultation documents. There have been changes. Yeah. So unfortunately, even if you're waiting, to know what is your status as a free zone person, we don't have much to tell you. We have to wait. Yeah. There's just one more thing, that is free zone person may elect to be subject to CT. So the law says you can actually elect to be subject to CT. So logically, you may ask the question, why would we elect to be subject to CT if we can get 0%? What that means is under certain conditions, it may be more beneficial for you to be subject to CT. And this is particularly the case if you have some businesses which are located in the free zone and some business which are located on the mainland, because by qualifying for the 0%, you may be actually giving away something else elsewhere. Right. All right. Now, so that is about who is subject to tax. So we've covered free zone persons, we've covered residents, non-residents, juridical person, natural person, and all of that. And I know it's a little bit to digest, but let's now move on to what income is subject to tax. Yeah. So this is a very simplified version of a P&L, a profit and loss account, or income statement, or whatever you call it. Yeah. So you've got revenue and various other income, direct costs, gross profit, operating expenses, and accounting net profit. Now, corporate tax is not computed on revenue. It's not computed on gross profit, but it is actually computed on the net profit. You may be wondering, why do I have, numbers like this, not round numbers? And I will explain to you that in a little bit. Yeah. Now, when we look at it, there are a few key points to remember. Like I said, tax is computed on the net profit, not on the turnover, not on the gross profit or any other line. Yeah. Second, it's computed at standalone level. Now, if you are running multiple businesses in the country, if you have multiple entities, then you will be preparing financial statements at each level. So the default position of the tax law is that you will be submitting tax returns at each entity level. All right. Now, if you are a natural person, let's say with 2 LLCs and 2 civil companies, then you will have to file a tax return for each LLC, and the 2 civil entities is a part of the natural person. So one tax return at the natural person level for the 2 civil entities. That's kind of how it should look like. All right. However, tax grouping is possible, and we will talk about tax grouping in a little while. All right, as to what is tax grouping and how does that work. The third point is accounting standards. Now, when you have financial statements like this, they typically follow one or the other accounting standards. The most commonly followed accounting standards in the UAE is IFRS, International Financial Reporting Standards. There are also companies which follow other standards like US GAAP. And under IFRS itself, you have something called IFRS for SMEs. So these are a simplified set of standards which are meant for the smaller businesses. Yeah, so there are businesses who follow that too. Now, the law does not say which accounting standards will be acceptable. The law simply says it should be in accordance with approved or accepted accounting standards. So we will have to wait for further decision to see which accounting standards will be acceptable. It's fairly clear that IFRS should definitely be acceptable. In fact, the FAQ states in itself that IFRS is the most commonly used accounting standards in the country. But in terms of whether other standards like US GAAP or anything else will be acceptable, it's something that we will have to wait and see. Now, why is this important? Because accounting standards, in case you don't know, they actually give guidance or principles around recognition and measurement of amounts. So what do I mean by that? So they say stuff like, when do I measure, when do I recognize this revenue? At what time? And what do I recognize it as? Is it revenue? Is it something else? Or when do I recognize this expense? And at what amount should I recognize this expense? These are the kind of things that are covered under accounting standards. And sometimes there are differences between different accounting standards, and accordingly the net profit that we compute may be different depending on the accounting standards that we use. Yeah, and that's why I deliberately put the amount as, you know, as not a round figure, because sometimes when you look at the income statement, it gives you a feeling of spurious accuracy. It's almost like this is an accurate, a perfect number, but it isn't. It is dependent on the accounting standards you use. And what is more, even within an accounting standard, there are several judgments, estimates, and assumptions. And sometimes an accounting standard itself gives alternative treatments. So depending on what judgment, what estimate, what assumption, and what treatment you use, these numbers could change, and sometimes drastically.
Yes.
Yeah. Now, right, so we know that tax is computed on net profit, but this is only the accounting net profit. As we go further, from a tax point of view, you know, you don't necessarily use the accounting net profit as it is. Sometimes you have to make adjustments to these accounting profits. Yeah, let's cover what those adjustments are. So first is, if there are exempt incomes, then they should be removed. So we are saying revenue and other income. So we'll have to then go into detail of the nature of each of these items. And if any of them fit exempt income, then you can take that out. Secondly, there's a concept under accounting called unrealized gains and losses. Now, I will not go into detail on this because it's a little bit of a technical subject, but the point is, if you have unrealized gains and losses on capital assets and liabilities, the law does allow you an alternative treatment, but it's an optional treatment. Then we have non-deductible expenditure. So we have direct cost here, we have operating expenses here, but some of those expenses may not be allowed as a deduction for tax purposes. Yeah. Apart from these, there are certain credits, and there are credits and reliefs, and also you may require some adjustments if there are transactions between related parties. So let's go into a little bit more detail on each of these items now. Yeah. So before that, so if you look at the numbers, what we did is we assumed that all of these tax adjustments resulted in a net increase in taxable revenue of 50,000. Now, it may not always be a net increase. In some cases, it may be a net decrease as well. Yes, please bear that in mind. But this is how you would compute your taxable income. Now, let's get into details on each of these items under 5. So first is exempt income. So first we have dividends and profit distributions. So if your company has investment in other companies and you're getting dividends, then that's exempt. Second is something called income from a participating interest. This actually relates to investments that your company may have in other countries. Again, it's a little bit of a deeply technical area, and there are conditions and criteria to be met. So we will move on, but do know that there is So there are some provisions in the law around income from a participating interest. Third is non-resident international airlines or shipping companies' income. Now, this only affects the likes of Lufthansa or Qantas or Air India or whatever. When they fly into the UAE, whatever income they generate from that flying, that is exempt from tax. But if they do any other kind of business, that will be subject to tax. 4 is income of a foreign permanent establishment. This, I think, requires a little bit more elaboration because this can affect a number of people. Now, let's say you have your company, which is resident in the UAE, and the company has a branch in Saudi. Saudi has a tax rate of 20%. So that branch may be subject to a tax of 20% on the income that it earns from Saudi. Yeah. Now, because it's the branch of our a company which is resident in the UAE, it is also subject to tax in the UAE at the 9%. So what that means is that company is potentially subject to taxation twice, once here, once in Saudi. So in order to eliminate this double taxation impact, what the law has is something called an exemption for income of foreign permanent establishment. So you could choose to exempt that income completely from your tax return. Now, again, there are conditions, etc., to be met. We will not go into the details. And as I said, this is a choice. It's an option. Now, if you don't take this option, then there is another approach available for us, and we will talk about that a little bit later. Yeah. Now, going forward, we talked about non-deductible expenditure. Let's see what is non-deductible. First, interest. So if you have interest expenditure in the financial statements, and we are looking at net interest. If you have interest income and interest expenditure, then what is the net interest expenditure? That is obviously deductible. However, there is a cap. You can deduct interest up to 30% of EBITDA. EBITDA is earning before interest, tax, depreciation, and amortization. Anything more than that, you can carry forward to the future up to 10 tax periods. Yeah. Now, again, that can become a little bit complex for those who are not familiar with tax. Second is entertainment expenditure. So as a business, you may incur expenditure to entertain your clients, customers, suppliers, shareholders, whoever. Those entertainment expenditure can also be deducted, but there is a 50% rule. That means you can only deduct up to 50% of the total entertainment expenditure that you have incurred. Now, if some of you are thinking, then maybe I should put all my, family restaurant dining, everything into the company, and then I can get a 50% deduction. No, because there is elsewhere a basic rule which states that you can only deduct business-related expenditure. So you cannot deduct personal entertainment expenditure. You cannot consider them in the business's financials. Now, there are a few others as well. If you have given donations, grants, gifts, they are typically non-deductible unless they are given to the qualifying public benefit entities that we spoke about a little bit earlier. If you've incurred fines and penalties, they are not deductible. If you paid bribes or any other illicit payments, obviously not deductible. Any dividends, profit distributions that you pay to your business owners, not deductible. And recoverable input VAT, VAT is an in and out. So any recoverable input VAT is not a deductible expense, and etc., because there may be other items as well, which may come in a future cabinet decision as non-deductible expenditure. Now we move on to credits and reliefs. So what exactly are these? So on top of, so we discussed what income is exempt and what expenditure are not allowed. But you may, on top of that, have some credits and reliefs. Yeah. So first is tax losses. Yeah. So a logical question in anyone's mind would be, if I have to pay 9% tax on my income, on my profit, then will I get 9% back from the government if I have a loss? Yeah. And the answer to that is it's a yes and no. Yeah. And why is that? So the government will not pay you back 9% on your losses, but the tax authority will allow you to carry forward those losses. The only rule is there is a 75% rule. So in any year, you can only carry forward up to 75% of the taxable income of that year. So if this year you made $1 million loss and next year you made $1 million profit, then you cannot offset the entire $1 million loss. You can offset 750,000 and the remaining 250,000 will be carried forward to the year after that. And there is an unlimited carry forward. So there is no kind of, there's no limit on the carry forward. Second is the law covers certain incentives or special reliefs for qualifying business activity, but there is no clarity in the law on what business activities will be considered as qualifying. The law refers to further cabinet decisions on this matter. So it's something that we'll have to wait and see. Third is group relief. So if you have multiple businesses, then there are certain reliefs that you could get. Yeah, so let's cover that in the next slide. Now, there are broadly two types of reliefs that you can get. So let's say if, and it's very common in the country that one individual may own multiple businesses. Yeah. So if you have a situation like that, where an individual owns multiple businesses, or it may be a holding company structure, non-holding company structure, whatever, it could be an individual ownership in multiple businesses. If the common ownership is 75% or more, then you can obtain certain reliefs or transfer of assets and liabilities. So if you're basically transferring an asset or liability from this entity to this entity, you may not have to pay any tax on the related profit. So it will be considered as transferred at book value. Secondly, if you have a loss in one entity and profit in the other entity, you will be able to offset them. However, there is the 75% limit that we spoke about in the previous slide. The similar 75% limit applies here. Yeah, but then there will be carry forward as well. So you will be able to offset them. Now, if on the other hand, your entities are structured in such a way that you've got a parent company, a holding company at the top, and then there are subsidiaries underneath that, and the ownership is 95% or more, then you can actually group them into one entity. So if you have a holding company and 5 subsidiaries which meet the conditions, then you don't have to file 6 tax returns. Instead, you can just file 1 tax return at the group level. So any intercompany transactions between them will be completely ignored for that purpose. And what is more, if you've got a profit in one, a loss in the other, you can effectively offset them fully. Yeah. Now, the last thing that we said when we spoke about adjustments was in relation to connected persons and related parties. So if you are entering into transactions with related parties, and there are definitions of who is a related natural person and a related juridical person in the law, we won't go into details on that. If you are entering into transactions with related parties, then you need to ensure that those transactions are at market value. This is what is called arm's length principle. Yeah. So a very simple example is, let's say Nish is 100% owned by me. Yeah. Now I am a connected person of Nish. The way law defines connected person is either an owner or a director or officer. So all the payments that Nish makes to me could be either because I own the business or because I run the business, I manage the business. Now, the payment, the salary that I take from Nish should actually meet the market value principles. If instead of me, or if I went to the market and with my qualifications, with my experience, I look for a job, what is the salary that I'm likely to get? I can only take that much salary from Nish. Only that will be considered as deductible. Otherwise, anything over and above that will not be deductible. Now, as you can fairly imagine, that's a fair range.
Yes.
So that is why, it results in assumptions and judgments and so on. This whole concept of arm's length principle is, again, it's a very broad area. And it's not only transactions with owners, it is transactions with any related entity. You have to ensure that arm's length principle is followed. And it's not only for foreign entities, any transactions with even domestic related parties, arm's length principle has to be followed. There is a broad area called transfer pricing. Under that, there are multiple methods under which you could calculate, or you could see the market value, or you could compute the market value of transactions. These are all internationally accepted methods, and these are the same methods that are acceptable here as well. Or you may use even an alternative method if none of these methods fit your conditions, fit your circumstances, provided the underlying conditions in the law are met. Right. Now, so that's about how to compute tax. As we've seen, the accounting standards are important, the judgments are important, the accounting profit in itself, how it's computed, is important, and then the accounting profit is further adjusted for various things. Yeah. So that's how you compute tax. Now let's move on to what do you do once you compute tax? Yeah.
Yes.
Yeah. So Nisha, do you want to maybe talk a little bit about that?
Yeah. So as Nish explained in our previous slides, we had seen that how we arrived at the accounting net profit and then how we got our taxable income. When we started with the presentation, I spoke about rates. We have 0% and we have 9%. So where does the 0% come into picture, and where does the 9% limit starts to apply? That is what we are covering in this table. So if you see, we have a taxable income of 484,567. So is 9% applicable on that? No. So the first ceiling that we have to consider is the 375,000. So 0% is applicable on the 375, and the remaining amount, that is the amount on which the 9% then applies.
Yeah, and maybe just one additional point, the 375 is not set out in the law. It's there in the FAQs, and as we know, the FAQs are potentially subject to change without notice.
So this is the expected amount, but we never know. So once you know that, okay, my total tax payable for the period is 9861, what do you do? In fact, even before reaching your total tax payable, what is required from you as business or from you as a taxable person to be done? That's what we are covering in the next slide. The first step obviously will be registration. Now, when it comes to registration, or as an audience, as a taxable person, you might have already experienced it when you registered for VAT. And in the recent developments, you might already know that there's a platform introduced, Imara Tax, under which what tax authorities are trying to do, I believe, is bringing together under one umbrella all the tax filings. That's how it works in KSA as well. You have like one username, one password, and with which you enter into the portal, and then you have your different taxes and obligations where you go in and file. There are discussions and questions around whether the TRN will be same, the tax registration number, whether it will be same as your VAT. Not necessarily and unlikely, because there are different grouping rules for corporate tax, and different, there is no threshold. So we are expecting that it will be a different TRN. Returns, your returns will be due for, suppose, say your first financial period that will be covered under CT. If you have a Jan to December financial year, then your first return that will be subject to corporate tax will be Jan to December 2024. And it will be due for filing within 9 months from the end of your financial period. The tax period, it is likely to be your financial period, so a 12-month period or part thereof. That's what the law says.
And it doesn't have to be the calendar year. In our case, Nish, for example, our financial year is October to September. So in our case, our first financial year, which will be subject to tax, will be October 2023 to September 2024. And we will be due to file by June 2025. File and pay.
File and pay. The next is the related documentations, financial statements that you have referred to arrive at your taxable income may be needed to be submitted. The cabinet decisions will declare certain categories of taxable persons who might require to even have the financial statements audited or certified. So we'll have to wait and watch.
Yeah.
Record keeping, all the documentations which you have, which you might need to prove to the authorities how you arrived at your taxable income. They need to be maintained for a period of 7 years from the end of your relevant tax period.
Yeah.
So we have to be similar to VAT.
VAT had 5 years, so at a different period. Yeah.
The next point here is about clarifications. The law do mention that if you have any questions or any clarifications required around the applicability of the tax law or any advanced pricing agreements, then you can reach out to the ministry through a clarification form.
Yeah.
There are anti-abuse rules set in place in law, obviously very important. This is mainly to combat any misuse or anti-avoidance of any abuse rules. Now, this might follow a more of a substance over a form approach.
Yeah.
Wherein tax authorities might be looking into, do you have any like agreements which you might have put in place which might not have any commercial or economic reality, or have you entered into any agreements or arrangements just to avoid or maybe have a turnaround on the around the rules laid out in the law.
Yeah.
So be very careful, I would say. Yeah. So we are moving towards the conclusion. So Nish, what are our concluding comments?
Right. So just to conclude, there are several conditions and criteria. Now, if you read UAE corporate tax law, and if you read corporate tax laws in other countries, the law in the UAE is way simpler, but that doesn't mean that it's entirely simple and easy. There are several conditions and criteria, and there will be complexities and judgments at various levels that you need to be aware of. Yeah, and these, the law in itself, the corporate taxation in itself, impact how you structure your business, how you structure your contracts, how you structure your intercompany, the related party transactions, and also how you structure your accounting. What accounting standards you use, what judgments you use, what options do you use, and what systems and what information do you really have available? Because return filing requires you to have certain amount of information, and if your structure, your systems are not ready to provide that information, that you may have to review them to ensure that review and make necessary changes. Yeah. And one important thing is that in order to tackle corporate tax properly, sound knowledge of both accounting and tax rules is important. What we will do is, this was intended to be a very high-level session covering various things and just giving a general overview of the tax, but we are planning more focus sessions in the new year once we have more cabinet decisions coming out. And what we'll also be doing is we'll be uploading online the video and the presentation of the session eventually. Yeah. If you have any questions, please, I think we already have some questions that have come in. So let's look at that. So there's a question as to what's the benchmark available for transfer pricing in the UAE, especially for the example that you have given. Now, the benchmark is not yet announced, so we will have to wait for further cabinet decisions on that. Yeah. For free zone entities having income from both free zone and mainland, how will it be taxed? So again, there is very limited information on free zone. As we said, qualifying free zones will be subject to 0% tax on qualifying income. So what is qualifying income is something that we will have to wait and see. And obviously, what are qualifying free zone entities or what are qualifying free zone persons, that is also something that we'll have to wait and see. So currently, unfortunately, we don't have enough information to answer that question. We have another question. Please advise if a company has financial year Jan to December 2023. Good one. So the law starts from June 2023. So it will only be applicable for financial years commencing on or after 1 June 2023. So in this case, Jan to December 2023 will not be subject to tax. The first year that you will be subject to tax is Jan to December 2024. And your return filing and payment deadline will be September 2025. Yeah. Please, can you show the slide relating to relief once again, the one after non-deductible expenditure? As we mentioned, we will be sharing the slides through emails and through social media.
And if you have any questions around that, you can send it over to us after the session as well, and we will try to answer those.
Yeah. Right. Sorry, we have a question. Other comprehensive income will incorporate and related expenses. I'm not really sure what the question is, so if you could elaborate, we will answer that. Offshore companies. So there's a question on how about offshore companies registered in JABZA offshore and RAC ICC. Are they also considered resident person? Again, we'll have to wait for further clarification on the free zone rules. There are no specific mentions to offshore companies anywhere in the law, or as far as I can recall, even in FAQs. So whether offshore companies will be treated any differently from the other free zone entities, that will be something that we will have to wait and see. Right, so we have more question coming in. What about free zone companies who had contracts for 5 years, especially the contracts signed before the law has applied? If we are asking about the anti-avoidance rules, the law was published in, it was issued on 3rd October 2022, and it is effective 15 days after publishing in the official gazette. So the law's effective date is 15 days after publishing in the official gazette. But from an anti-avoidance rules point of view, the law says that those rules are effective from the date the law is published. So any contract or arrangement that you entered into from the date the law is published will be subject to anti-avoidance rules, which potentially means that anything that is entered into before is not subject to it. Yeah. And there's a question, will income earned by an individual from bank deposits be subject to UAE CT? The answer should be no, because that's not a business income. Yeah. I think we are effectively running out of time. If there are no further questions, then thank you very much for listening in. And if you have any further questions, please feel free to come and write to us, email us, or write to us. Like we said, we'll be conducting more such sessions in the future, and we will be
and if there are any topics that you would want us to present on, you can send in your suggestions as well.
All right. Thank you very much for listening in.